Good morning, good afternoon, and good evening to our network joining globally. Welcome to Invest Africa's 2026 Southern Africa Outlook webinar, the first in our series this month. I'm Chantal Carrington, CEO of Invest Africa, based in the UK, originally from South Africa. With Invest Africa being a leading platform to drive capital from the capital hubs to Africa, we will be unpacking the African region's economic and risk outlook to keep our network informed as they navigate Africa's investment. Today, we will look at how the Southern Africa region can break through structural constraints and elevate its growth trajectory. The speakers will be touching on mining, manufacturing, and industrialization, with a global shift to clean energy, demand for critical minerals, and localized manufacturing, as well as downstream processing, offering new opportunity, particularly in South Africa, who recently hosted the G20, Zambia, who have upcoming elections, and Botswana, who is looking to diversify. Regional integration and trade will be discussed to look at better transport, port, and logistics infrastructure, linking landlocked countries to trade gateways and leveraging regional value chains. Governance, fiscal, and currency risk will definitely be on the agenda, with high public debt, policy uncertainty, and currency depreciation, emphasizing structuring resilience, improving investor confidence, and of course, managing risk. Now, Lydia is fantastically placed as partner and head of corporate M&A at Baker McKenzie to lead this conversation. So Lydia, let me hand over to you for an introduction and also welcoming Rufaro and Mulenga. Thank you.
Thank you, Chantal. Good afternoon, everyone. Well, it's afternoon here in South Africa. And welcome to our 2026 Southern Africa Outlook webinar. I'm Lydia Shadrach-Razzino, partner and head of M&A at Baker McKenzie, South Africa, and I'll be moderating today's conversation. I'm joined by Mulenga Mutati, CEO and Head Actuary at Gralix Holdings, and Rufaro Mapanda, Head of Equity Trading at Absa. We're gathering at an important moment in a VUCA world, which is volatile, uncertain, complex, and ambiguous. And 2026 has already shown us that this is not going to change anytime soon. My view is that VUCA is the new normal, and Southern Africa is no different. Southern Africa enters 2026 with growth still modest, yet edging up. Regional GDP is projected to rise from 3% in 2025 to 3.1% in 2026. That slight uptick is not the story on its own. The question for us is, how can the region break through the structural constraints, power, logistics, policy predictability, and convert reform and private sector engagement into bankable, scalable investment outcomes? As Chantal mentioned, we'll be diving into 5 interlocking themes: macroeconomic and investment landscape, mining, manufacturing and industrial hubs, energy reform and transition, regional integration and trade corridors with the spotlight on Lobito, governance, fiscal and currency risk, and we'll close by focusing on implementation credibility and how announced reforms become bankable projects and the deals and structures most likely to move from concept to close in 2026. Just a little bit of housekeeping. The webinar is scheduled for an hour. We will have a Q&A panel that you are all welcome to engage in at any time, and we will deal with the questions either woven into the discussion as we see them, or at the end where we will allocate some time for Q&A. With that, and on that note, let's dive into the first theme, which is macroeconomic and investment landscape. A forecast moving from 3% to 3.1% suggests stability with modest momentum rather than a pivot to high growth. The crux for investors: which signals, inflation, rates, fiscal consolidation, FX, indicate resilience, and where are the realistic pathways beyond single-digit growth? Let's unpack sentiment, capital flows, and the reforms that could meaningfully shift the 2026-27 narrative. Let's kick this off with you, Rufaro. What does a projected GDP increase from 3 to 3.1 realistically signal for investor sentiment in the region?
Well, thanks, Lydia, and thanks for putting me on there. It's good that you broke that down by starting off with looking at the region and the difference between 3 and 3.1%. We try not to look at aggregates because investors can't invest in aggregates, and they don't really tell the story, right? A single country GDP figure might be looked at differently by different people in different industries, whether it's investors or people who are already in the country. That said, the key for Southern African markets is really in the current published GDP figures. And I think the number itself, the difference between 3 and 3.1 doesn't tell a full story and doesn't show what's happening in the different countries. You mentioned countries which have elections this year, like Zambia. Zambia has gone from 3.8 and has clocked 5.3, 5.8, and 5.5 over the last 3 years. That tells you that there's a very serious story in Zambia, driven by sort of transparency in elections and copper prices. Whereas Bots is a bit of a different story. I mean, it's been a tough map for them, down 3%, down 2.5%, and probably only looking at 2 and 2.5% this year and next year. So I think just looking at that, you have two very different stories in Southern Africa. And I would probably, if I had to give a choice to people, I'd probably look to people to look more north to Zambia. South Africa on a relative basis looks to be a good story, but I mean, we're only clocking 1.9% this year and next year. But given it's only been 0.5 over the last 4 years, it's still green shoots. So if I had to rank them this year, I'd solidly put Zambia, Mozambique, Bots, and then South Africa on a GDP basis. But as Mulenga can tell you, there's a lot of other things to look at.
Yeah, no, thank you so much for breaking that down, Rufaro. You're spot on. Looking at aggregates certainly doesn't tell the full story, and you've got to look at the central indicators in each of those countries, right? So thank you, very, very, very insightful. Mulenga, moving on to you. Which macro indicators should investors prioritize when assessing Southern Africa's resilience in 2026? Inflation stabilization, rates, fiscal trajectory, FX outlook?
Yeah, thank you very much for that, Lydia, and Rufaro, thank you very much. Like you said, Zambia is leading the charge sort of over the last year. It almost feels like, we've won the World Cup, not the World Cup, actually, the African Cup of Nations again. But in all honesty, I think if I look at the past year, one area that investors should probably be focusing on as we go into 2026 is obviously goes without saying the global commodity prices. We're at a period, if we think about it globally, where there's so much uncertainty in the West. We have, policy uncertainty coming out of US, Ukraine war, etc. So obviously with that, what investors tend to do is put their money towards, safe haven assets such as gold. And we've seen that of gold has really rallied over the last year. Copper has also come to the party, increased demand for EV vehicles, increased demand for AI and data center infrastructure. So I think investors should be looking at these metrics as we go into 2026, the prices of commodities, as well as infrastructure bottlenecks. How is the region dealing with these infrastructure bottlenecks? Key area, I'm sure a number of you are aware, the Lobito corridor, which is supposed to connect the coast of Angola to the mineral-rich Zambia and DRC, would be a game changer to help in deal with those infrastructure bottlenecks. As well as another thing that, it will be a resounding theme, I think, through this webinar is the power situation. Being in Zambia, I never thought that would actually experience load shedding. I remember I used to visit South Africa a lot in 2023. I actually used to make fun of South Africa and say, I can't believe, such a developed country and you don't have electricity. And then it hit Zambia. Last year was very bad. We had about maybe 3 hours of electricity per day. So as they say, he who laughs last laughs the loudest. But as we go into 2026, it's stabilized. We have quite consistent power. There's some areas that we still need to work on, but I think this is a key area that investors should be looking at, because without energy, it sort of hampers the growth that has been experienced so far. Thank you, Lydia.
Thanks, Mulenga. Completely agree with you, and thank you for touching on the gold price, the copper price, the demand for EV vehicles, and also how load shedding started back in South Africa, I think around about 2008, 2009. And the rest of the world was, and particularly our neighbors were shocked by it. But the energy crisis has now long left our borders, and I think we're starting to feel that pinch, not just in our neighboring countries, but also globally, right? So thank you very much for touching on that. Rufaro, back to you. How have global capital flows into emerging and frontier markets shifted, and what does this mean for Southern Africa's competitiveness?
Actually, I think we have to look global. We have to start globally and start on top, really. I think the theme in the last couple of years has been higher for longer, and that sort of rewired the picking order in terms of where flows go, as global rates reset upward at the time. And then capital just became more selective, more price sensitive, more volatility averse. I think people wanted to show, or markets really wanted to show a thing, more passive, less selective, more, what people just wanted less volatility, really. So I think in that framework, we've seen, you can break it down into three things. Markets are rewarding countries with credible inflation is the big enemy of markets, really. So credible inflation frameworks, manageable debt refinancing profiles. So yeah, you default in debt, but what do you do about it? And the liquid markets, the depth of your markets. And if you bring it back to Southern Africa, if I stay away globally, they've really been a couple of countries which have done this well. I don't want to blow Mulenga's horn again, but Zambia was pretty decent in shuffling itself out, and Ghana, and they've benefited from this macro view of selectiveness. If we break it out to competitiveness, I always like to say this. I know if we're talking about the AFCON and how everyone's focused on our neighbors, but I think when it comes to competitiveness, your real competitors are credible reform stories. So it's not just your neighbors. It's not if you're in Lesotho, it's not what's happening in Swaziland, because they look like your size and they're who you see yourself competing with. The world and the markets really see EM and frontier. So Mexico and Chile screen against Uganda and Nigeria. When Nigeria is going for that auction, the people who are not looking at the US, who are looking for that yield, you're running against Mexico and Chile. The borders are frictionless now. It's not a distance thing. So capital has become more fluid than ever. And in a sense, the presence of passive money has meant selectiveness is less on the investor insight and more on just clocking those benchmarks. If there's ever been a time for Southern Africa to stick to uniformity and just ticking the boxes, if you tick the boxes, I've always said politicians don't have to come up with these amazing slogans. Just tick the boxes and you will be rewarded by the market.
I agree. It's all about credible reforms and tangible credible reforms, and things that we can actually see and feel. Mulenga, just moving back to you, where are the most credible pathways for the region to move beyond single-digit growth?
Yeah, so good question. I think building on the momentum of the critical minerals sector, and I think this is a story that we keep on saying each year, the last 5 years or 10 years or whatever, but it's important for Africa to focus on building up local value chains. So by that, I mean local manufacturing, local processing, and increased local participation through the minerals sector, as well as now linking these local industries to the global trade systems. But with that, again, it takes us back to the issue of infrastructure, right? how do we link what we have as a mineral-rich continent to the global markets? Projects such as Lobito Corridor again, and as well as energy. Energy. If you think about a local manufacturing company, you think about a local processing company, for them to produce their goods, you need consistent and stable energy. It'd be almost impossible to actually compete with other industries if you're only having electricity for 3 hours a day, for example. So those are the sort of, building blocks. And then thereafter, obviously, then financial services follows, right? If we have the producers really making an impact, a lot of projects going on through the African region gives opportunities for banks to sell their products, gives opportunities for insurance companies to sell insurance policies. So that whole ecosystem will benefit from us getting, the infrastructure right and building on the momentum that we've seen from the growth or the demand of our critical minerals in the region.
Yeah, you're spot on about the significance of the Lobito corridor in order to be an enabler for all of the things that you've just mentioned. And we're going to focus on that in I think it's our third or fourth theme, so we will get there. I am very excited to have that conversation. But we can move on to the next theme for now, and that's mining and industrialization. With global clean energy demand accelerating, copper, nickel, manganese, PGMs, and other transition metals place Southern Africa at the center of the supply chain. The opportunity isn't only upstream. Processing, refining, beneficiation can create industrial hubs in South Africa, Zambia, and Botswana if we align policy, infrastructure, and financing models. Mulenga, I want to kick this one off with you. How can Southern Africa capitalize on rising global demand for copper, nickel, manganese, PGMs, and other critical minerals? I know you've touched on it, but if you can unpack that just a little bit more for us.
Okay, no, that's sure. So, if we think about it, there's been an extensive drive towards clean energy over the last year and the year before. And with clean energy, we think of, say, your solar panels, right? So key components that make up the solar panels are your copper, your lithium, cobalt, etc. So with this, there's obviously a growing demand, and I think it's showing in the fundamentals and the increase in the prices of these critical metals over the last year. So I believe the prices of these are expected to continue to rise as globally, as we shift to greener sources of energy. So as a sort of a country that's at the center of it, another key component, and we've seen this happen in Zambia recently. There's a new processing company that was established. Basically, it makes copper wires. So they're taking advantage of this increased demand for greener energy, and not just producing the copper, but then taking it to the next level to produce finished goods. I was actually speaking to the founder a couple of weeks ago, and he now wants to take it to the next stage of the value chain and start producing solar panels. So these are the areas of, consistent vertical integration across your value chain would help Africa really benefit from this.
Yeah, it is definitely time that we move beyond extraction into refining, processing, and beneficiation. And I think you're absolutely spot on, and that was very, very insightful. Rufaro, moving to you, what investment models, PPPs, offtake agreements, blended finance, will accelerate industrial development?
So look, in my previous life, I did private equity and project finance. You're getting me to get into some juicy stuff here. But if I come to my current wheelhouse, just need to support Mulenga on what he said. I mean, and as a house, we've been generally calling platinum group metals and gold up for the last 5 years. We at $1,500. We called gold 5,000, and I think the next stage is these next metals he's talking about. I think there's big room to run, and if we as Southern Africa position ourselves correctly, I think there's lots of good work to be done. But going back to your question, we spent many nights talking about which investment models are better. It's an academic argument. But I think when it comes to practicality, the fastest industrial acceleration usually comes from stacking models. You really, because at the end of the day, all you want is bankable revenue. You want to mitigate your risk. You want long tenure capital. You don't want short-term capital. So rather than just picking one model, especially as Southern Africans, where our market is evolving, we're learning all the time. There's a lot of different forces, as West Eastern forces coming into our market. So you can't just pick one. I think in the market you wanna combine these things and take the best things. Mulenga would agree with me on this. And based on that, I think there's three standout winners for industrial development in three particular silos. So the first one would be industrial power to production, a stack, where you've got a corporate PPA and offtake program, a bit of wheeling and a guarantee, and then long-term and DFI debt. Who is this for? Again, we got to be specific. Who is this for? I think this is for green manufacturing, who you spoke about earlier, minerals processing, data center, and agro processing. Mineral processing, very important for countries when you think of countries like Zambia and the Lobito corridor. So that's people who should be looking at this. The second one also, and also applies to that place, would be corridor competitive stack, which speaks to Lobito. So where you've got rail port concessions and triple E's and take or pay volumes for exporters, blended guarantees for capex, and in this situation, we want to drive KPIs. We're not communists here. We want to make some money. So who should this be for? For export-led beneficiation, agro and export hubs, which we're trying to build here. So this is very pertinent in Southern Africa, where we've got two coasts. We've got the western and eastern coasts, and on both sides we've got copper, iron ore, and cobalt. So this is an area where we should be focusing on and thinking of these type of stacks. And then the third stack, which I don't like as much, but I'm going to bring up because it's very popular with the political parties, is the SEZ, the economic zones and the industrial park, the utility stacks. Good for park utilities, I think really for power, water, and waste, and for local currency lending. And that probably speaks to light manufacturing, pharmaceuticals, cold chain, pertinent for South Africa, where we're looking at the prospect of Chinese vehicle assembly on the continent. So a game changer, but I think the top two would be the ones I'd focus on.
Absolutely love that, Rufaro. Structure stacking. I'm going to borrow that from you if you don't mind.
No, please.
But I think that's great. Structure stacking is definitely the way that we need to tackle it. There can't be a one size fit all. And in order to capitalize fully on the opportunities, structure stacking seems like the way to go. And you may not like the third stack that you mentioned, but we've seen quite a bit of activity there over the last 6 months, which came as a surprise to me as well.
True. That's just me. I've accepted I'm not being flexible. I actually think it's great. But I'm a markets guy, so I like the things that move the needle for the people. So, the top two only because I'm biased towards commodities. But I agree with you. I think they work. They work.
Yeah. You and I both. We're similar in that way. We can move on to the next theme, and that's energy reform and transition, which is, I think, the topic in most boardrooms at the moment, particularly Southern Africa. And Mulenga, you touched on this as well. Power bottlenecks remain a binding constraint. Utility reform, renewables integration, and cross-border trading are crucial to de-risk industrial scale-up. The question is how to fix legacy utility issues while crowding in private IPPs, and where do the quick wins lie to boost investor confidence? We'll kick this one off with you again, Mulenga, if you don't mind. Which energy reforms underway in South Africa, Zambia, Namibia, Mozambique have the greatest potential to shift investor confidence in your view?
Thanks a lot for that, Lydia. So I think obviously I'll use the champions Zambia as an example. I'll use that as a case study. So recently we had energy reforms, and I'll pick sort of the top three that seem to have really moved the needle. So, for example, government reduced the approval time required for solar projects, right? So previously, investors coming to build solar farms, etc., the approval process would take up to 20 or over a year, so 25 months and above. Now they've cut that down to just 48 hours, right? So speed of doing business has decreased. Um, then two, they've opened up the market. So previously, most of the energy was, consolidated with ZESCO. So ZESCO is the equivalent of, say, Eskom in South Africa or ZISA in Zimbabwe. So our utility electricity company. But now government has opened up the energy sector to allow independent power producers to play within the sector, as well as traders. So that's helped. Remember, I talked about the period of load shedding last year. The introduction and the opening of the market has helped alleviate that load shedding. So the IPPs and the traders are able then to help bridge that gap or fill the gap where we have energy deficits. Another one, and this is where government is putting their money where their mouth is. There's a solar project. So recently they announced it's called the Presidential Constituency Energy Initiative. So essentially what the government is doing is building 2 megawatt solar farms in each of the 156 constituencies within Zambia, with the hope to create 312 megawatts when it's done. They've allocated up to $100 million for this particular project. So it just shows the intention, government's intentional about fixing the energy and building the energy infrastructure. I think those are the three areas basically, provide the flavor of what has been done in the region to fill that energy deficit.
Thank you so much. It is incredibly impressive for any government approval process to take 48 hours. And I'm not one to be easily impressed. So well done, Zambia.
Thank you, Lydia. I was just going to add, so I spent most of my life in the UK and moved back to Zambia. And trust me, the approval processes for most things were months on months, and I could not understand it. But this is a sign that we're definitely moving in the right direction.
And it's actually what we should all be doing and working towards. We do global M&A transactions and we work with regulators across the globe, not just Africa. I don't think I've come across a 48-hour approval process in any of those transactions. But Rufaro, moving on to you, and particularly because you're South African, I'm going to be asking you the following question. How can the region address legacy issues in state-owned utilities while attracting private IPPs?
Well, look, I'm going to try and address this in a very practical way, but also looking at some using a bit of philosophy here. I think we use the term Ubuntu a lot when we talk things outside of the business context. But I think if we applied it in our working lives, we'll be able to really learn a lot from our current situations. A lot of the things that are happening with state-owned utilities have happened in the private sector already. And I can go right into this. I mean, we can start by separating the problems, a legacy book versus new build lane, sort of creating bad utility debt SPVs that hold old debt, disputed contracts, and non-performing assets. We already do this in listed markets in the private sector. I mean, all of you have heard about good bank versus bad bank. Banks fail all the time. Don't quote me on saying this. But the world doesn't stop shifting. We separate the problems and we deal with it. Another quick fix is off-taker risk. I think without waiting, I think sometimes we seek perfection where there isn't perfection. Without waiting for the utility to be perfect, we can already seek bankable payment securities as the number one unlock, even if it's partial. A simple one, which is happening in SA, I think I always feel people think things aren't happening fast enough, but they are happening. Unbundle where it matters most. Have an independent grid, transparent access, even before full reform. Results breed results, and momentum is king. Standardized contracts, we have you for that, Lydia, and procurement to just reduce this policy risk. I think that's missing in a lot of the continent. Tackle the real utility legacy auctions, legacy problems. We have amazing payment startups coming out of Zambia, South Africa, all over the place, in an environment which arguably is unbanked. So collections, municipal areas, and losses are already an area of expertise in private sector. And really that capability should easily be passed on to government. Align tariffs, subsidies transparently, allow private power with utility and balance sheet exposure, and just build credible enforcement and dispute resolution plans, which in SA we already do have. I think a lot of things that are happening in Southern Africa happened in Latin America. And bringing back Ubuntu, I think it's easy if we open ourselves to learning. Latin America solved the core problem early. They separated private investment returns from state utility balance sheets. We've got 3 countries we get along really well with who've done this. Chile in the 1990s, Brazil with the renewables. I think utilities can be imperfect if the contract is perfect. And the fact that we're having this conversation means this can be done and should be done. I mean, Zambia's gotten to 48 hours. This should be elevated at certain platforms. And I think us talking about it is doing the work, but I think more can be done.
Absolutely. I'm also an eternal cautious optimist. And I also agree that I think it can be done. And you're right, sometimes it seems to us that things are moving way too slowly. But if you actually look into the detail, you'll see that change is actually happening. And I think we can also feel it, particularly in South Africa with the significant reduction in load shedding, right? And the unbundling transactions that have happened and are currently taking place at Eskom. Rufaro, one more question on this point for you. Where are the quickest wins, do you think, for expanding cross-border energy trading?
I'm just going to blurt these out so that I don't get. I think the quickest wins, and some of them won't involve you, Mulenga. I think use spare capacity on existing interconnectors. I think for the non-technical, that's a very immediate win. Focus on high impact corridors. What are high impact corridors? Mozambique and South Africa. There's just been not enough focus on the hydro and gas flexibility via Cahora Bassa. Mulenga, you get a chance here. Zambia, DRC, Zimbabwe, hydro balancing and baseload swaps. And that has happened. And an example of that is, Mulenga, I think you noticed in December, it was less load shedding. I don't want to use no load shedding in Zambia. Why is that? Because in December in South Africa, seasonally, there's less power demand. A lot of our people love to go to the coast and they use less power, which allows Eskom to export more to Zambia. Very dynamic, probably under-celebrated and underused as an asset across the corridors. Namibia and South Africa, shortage smoothing. Zambia and Botswana, there should be a newer link. Maybe it's not optimized. I can go back to the bilateral PPAs, Lydia. That's your wheelhouse, and they are faster. I think, I don't want to use I don't want to use the USA as an example here, but what's happening in the West has focused the world to focus on more bilateral agreements. A lot of countries were not doing the homework because of big organizations like the UN, the AU. So countries got a bit lazy. They didn't do their homework. And I think this new world paradigm has forced people to focus on international relationships in their truest form, the relationship between Zambia and South Africa. And I think bilateral agreements are much faster to implement, and they can be positive, and they should be. So I would there's a lot of other stuff we could focus, maybe target 1 or 2 regional backbone upgrades. Again, not doing everything, not piecemeal, just strengthening Mozambique SA corridor, Zimbabwe SA path. There's a lot of work the government can do with, I think, support from the private sector, and these small upgrades and small bilateral pathways will probably unlock hundreds of megawatts at a fraction of the default conversation we always have is, are we going to build nuclear power plants or build? And these are mega billion projects. And people think taxpayer and all that stuff. And I think there's a lot of work that can be done bilaterally.
I like that, and I'm going to use your stacking theme that you mentioned earlier. When you stack these small things, they will result in bigger outcomes, right? And what if we've got a good focus on those? And I think that's a great segue, Rufaro, into the next theme, and that's regional integration and trade corridors, particularly with a spotlight on Lobito. The Lobito corridor could reshape the energy transition minerals value chain, linking Angola, Zambia, and the DRC to global gateways, unlocking logistics, processing, and services along the route. Financing partnerships, PPPs, blended finance, and effective trinational coordination and collaboration will determine how quickly Lobito shifts trade patterns and value chain integration. Mulenga, I'm going to bring it back to you. What do you think makes it the most strategically important corridor for the energy transition minerals value chain?
Thank you, Lydia. Yeah, so as you mentioned, so Lobito corridor links DRC, Zambia, all the way down to the coast of Angola, and therefore the Atlantic Ocean. And that provides sort of a port or a gateway to transfer goods all the way to the Western world. That helps in the sense that I'm thinking about, DRC and Zambia. I know Rufaro talked about the Mozambique and South Africa corridor, but for us to transfer goods, say from Zambia out into Europe or into America, we tend to either go through Tanzania. So if we're going towards Europe or towards the east, or we go down to South Africa. The time that this takes is quite significant, right? So more time, more cost in terms of logistics, etc. With the development of the Lobito corridor, this will cut down the time it takes to transport goods from these mineral-rich countries such as DRC and Zambia. With a reduction in time, the expectation is also the cost of logistics will reduce and shave off weeks of transit time compared to what we previously experienced. So this is particularly important. I like to think that, if you can do things quicker and cheaper, you become more creative and innovative, right? So with that, it opens up possibilities for other critical goods, not just on the mineral side, agriculture, to use and leverage this corridor to then export and connect Africa to the global trade systems.
In the age-old saying, time is money, right?
Exactly.
So just staying with you on this theme, Mulenga, what downstream opportunities do you think could emerge along the corridor? Processing, logistics hubs, warehousing, other services?
Yeah, certainly. So, if we think about it, Lobito corridor, for those that don't know, is essentially, a rail line, right? Connecting these three countries. Across the line of rail, it opens up opportunities for development, right? Many cities can develop across the line. Gives opportunities for SMEs, value addition along this line. So development of terminals, with the development of mini cities, this gives opportunities to construction companies. Beyond construction companies, again, we go back to the financial services. They'll be looking for banking products, right? They'll be looking for insurance. Schools may open across the corridors. So and this is sort of talking back about infrastructure development, when you build infrastructure, all other investment opportunities is basically following infrastructure. Right. To put it simply, my wife and I are sort of looking for, parcels of land in rural areas. But we won't buy a piece of land if there's no road that leads to that piece of land, right? So in simplistic cases, that's what investors look for. They want to be able to access land or access areas easily, and that's what the local corridor does.
Thank you for breaking that down so simply and so practically. But that practical example that you gave about looking for land and won't buy the piece of land unless it's accessible is key. And that's actually what we need is infrastructure development in order to attract more investment. And I think that the corridor, for me, I've been doing some research into it, is a super exciting opportunity across the region. Rufaro, just moving on to you, how do you think these three countries can better coordinate governance and regulation in order to capitalize on the opportunities that may emerge along the corridor?
So before I go there, Mulenga, I'm also very interested in the land that you and your wife are looking at. So give me a call on the side.
Certainly.
But Lydia, going back to your question, weirdly enough, I think it's a very simple answer. The fastest way to coordinate governance and regulation is by building a corridor state on top of the three states. This is not a new idea. We've done this before. When poaching was a massive problem in the 80s and 70s, Mozambique, Zimbabwe, Botswana, South Africa, Zambia, even at a time when there was an apartheid state, there was a Rhodesia, Zambia was at odds with that. In that particular area of national parks, they somehow managed to coordinate. The state of affairs is very different now. Mongolia and Zambia and DRC are great friends. So the good news, the building blocks already exist. And just to say, we as you said earlier, we don't celebrate enough what people have already done. The three governments have already signed an agreement. It's a very long LCTTFA, the Lobito Corridor Transit Transport Facilitation Agency. They're going to have to think of a cooler name. But in essence, they've looked to empower the corridor institution by making binding technical rules and processes, a single corridor clearance, coordinating regulation, and because we're now in the age of data, a shared data layer, and centralizing or coordinating financing. So here, I don't even think I have to advise them. I think that the three nations are already on path to deliver what I think would be what's necessary to coordinate good governance and regulation.
Thanks for that, Rufaro. I'm just cognizant of time, and because I want to get to the Q&A, and I see that there are a number of questions already submitted. If I can ask you, Rufaro and Mulenga, to just cast your eyes over the questions. There are some that are specific for each of you. And I'll try and move through the other themes that we still have to talk about quite quickly. The next one is governance, fiscal stability, and currency risk. Mulenga, this one I'm going to kick off with you again. And how can governments improve predictability in policy, licensing, and regulatory environments?
I was on mute there. Yeah, so I think policy stability, right, is important. And with most governments, if you think about Africa, most governments have a 5-year term. Consistent policies throughout that term, consistent and predictable policies throughout that term is particularly important. And these policies should be adaptive, right? Africa is a consistently changing environment, and it's very important that the policies should not be so rigid such that if something changes, you have to now run to Parliament to make adjustments. And also when I think about it now, before, policy uncertainty was one thing that was really attached to the Southern African continent and in Africa as a whole. When I look at it now, it's the story has sort of flipped. For example, I was planning to go to the World Cup next year in the US. Plans have changed quite quickly in recent times. So I think we're getting there as a continent. And also what really helps us, particularly in the Southern African region, is democracy, right? So we've been through a situation where we've had different governments come in and there's been a smooth transition when they come through. This has also helped create investor confidence and also helped investors understand that there's stability in these sort of particular regions. And also one thing to think about government, and I think government is doing that quite a bit now within the region, is, using data, right? Data focused decisions, rather than, following or working on more so on building the political credibility. It's looking back at the fundamentals and the data to then create reforms and create policies. I touched on the energy reforms, and this is a classic example of them, looking at what the numbers are saying, looking at what the situation is on the ground to then enhance the investment environment within the region.
Thanks, Mulenga. 10 years ago, policy reforms across the continent were an issue. And I think that we've actually come a long way since then. And I also completely agree, being adaptable in respect of our policies is also key because of this uncertain, complex, volatile world that we live in. Policies have to be adaptable. And you're right, not having to go back to Parliament in order to change a policy is a very, very, very important step. Rufaro, just moving to you quite quickly, how can central banks support currency stability without constraining growth?
Missed the mute function there. I'm on mute there. Okay, so I might turn a bit academic here, but you want stability without strangling growth. And I think there's a term we use when we address this thing. There's a thing called the trilemma. It's literally a triangle. And on it, you have three choices. You can have independent monetary policy, free capital flows, or a stable exchange rate. The thing is, you can only do two of these extremely well. And the other one, you really have to just give it up. So you can focus on currency stability. That would entail some type of control on either capital flows or monetary policy. So, and let me use a case in point here. So South Africa has independent monetary policy. In fact, I think something people may not be aware of is South Africa is ranked second in terms of the Federal Reserve Bank, in terms of if our governor and his team were a football team, they would be ranked second in the world. I'm not sure if both of you are aware of that. Don't worry, Mulenga, yours will come up shortly, but South Africa ranks second. So and then so you have independent monetary policy, but then you also have a stable exchange rate. The exchange rate is predictable. People can go out and they can trade on it. But the thing we have given up is that we do not have free capital. We don't have free capital flows. So we have exchange controls in South Africa. That's, if you look at it in terms of that, South Africa manages its growth in the context of its monetary policy. I don't know if I've helped giving an answer to that, Lydia. I went very academic there, but stability doesn't strangle growth. It's managed in context of the growth, and the Reserve Bank sort of opinion or view of where they think the country is going. So our Federal Reserve Bank governor has been described as a hawk by other parts of society, and people always think he's going to raise rates. But if you look at the stability of South Africa in context of the rest of the continent, he's done a pretty good job of doing that. Others may argue he has strangled growth, but he's had to to work within the remit of that. Countries which haven't done that, like Turkey, where the Reserve Bank governor gets fired when the president wakes up not liking him, or what's happening in the USA, for example, that 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 maybe lets growth on a rein, but it comes with its own costs.
Yeah, no, thanks, Rufaro. It was quite academic, but I think the soccer analogy really helped. And I do agree, you know, our governor, I think, sometimes gets criticized quite a lot in terms of strangling growth. But my view is that I think he's got a firm hand, but a steady hand. And it's certainly helped guide us and keep some momentum, even though slow, in a very volatile in very volatile circumstances. I don't know if the two of you have had an opportunity to look at the Q&A and are ready to answer some of the questions, because I'm just cognizant of time and I would like us to engage with the audience a bit. Happy for either one of you to jump in and take the reins on that.
I can jump in. I don't know. Do you want us to read the question or just answer it?
I think read the question, because it's only we can only see it, everyone else can't.
Okay, I'll take a question from Thabo Dimema. He's a banker in Absa here where I work, and he says, question for Rufaro: at the G20 and B20, we heard several rating agencies admitting that Africa does have an unfair risk premium, and vowed to do better to understanding our risk dynamics and recalibrate their models. Do you see this happening this year or anytime soon? What would the credibility of an Africa BRICS domiciled credit rating agency with alternative credit ratings for African states be? In this point, I'll give a case study to answer this question. Pre-1994 in South Africa, we were closed. We're closed the economy. So we're at a market, very old market, 100 years old. But there were only local brokers in South Africa and local asset managers. When the market opened up and international brokers came on board, they bought up all the local brokers and the market went up. There was more visibility, more understanding, more fairness in the system. 20 years later, the banks, so at that point in time, the local banks weren't even in the market. Now, if we look currently, Absa, Standard Bank, we are all in the market competing with the international banks for the same South African share. And again, the market has gone up. So I'm a big believer in that the more players or the more participants in any industry, or in this particular case, in the ratings, the fairer and the more objective the views. So I think whether it's Asian credit ratings agencies or BRICS or African, I think this will bring better parity, not even an alternative. It will just bring a broader view of people and bring us close to parity on where the fair premium is. And I think it's been acknowledged. It's amazing that it was acknowledged that I mean, we would never have had the acknowledgement a decade ago. But now, what do we do about it? And I think opening up the sphere, and it would involve maybe governments or the private sector stepping in and providing this capital.
Thanks, Rufaro. Thabo, hope that's answered your question. Mulenga, would you like to take a question?
Yeah, I'll grab one. I was going to grab one from Thabo, but maybe let me give. Okay, I'll answer it quickly, then I'll grab one more just to give other people a chance, because it's an interesting one. So from Thabo again, on the issue of Kariba Dam stroke hydropower and the impact on the energy market of Zambia, do you feel the government's response is adequate, and what's the progress of adopting renewable energy in Zambia? So yeah, listen, this was a massive issue, a couple of years ago, maybe even early last year. Hydropower obviously works off, the rivers being full. We had a period of drought, right? And that drought obviously created a whole cocktail of problems. Farmers couldn't harvest, so there was a food supply shortage. And then again, electricity was impacted, and that's what created, our 3 hours of electricity, which then again turned into reduction in economic activity. Because if you think about the low income stroke middle income population, the welders, those that own barbershops, they don't have the capital to build, solar panels or put solar panels to help them with their businesses. So you see a lot of businesses basically getting shut because of that problem. And in response, government then went to implement these energy reforms that I touched on. So A, reducing the approval process for solar farms, for solar projects. And then B, opening up the market to IPPs, so independent power producers. And then finally, we have them, again, putting their money where their mouth is, investing $100 million in building solar farms all across Zambia. So I think it's enough, but obviously enough is relative. There is obviously more that can be done, but I think they've responded quite quickly to the problem that we had. I hope that answers your question, Tabo. And then there was another question I just want to touch on quickly from an anonymous attendee. Essentially, they've asked, how can international finance centers support investment into infrastructure projects in Africa, or what is already happening successfully in Southern Africa with international investors? So, key examples. I had the privilege of going past the Kazungula Bridge. So, Kazungula Bridge is it's a bridge that connects Zambia to Botswana, right? And it's beautiful. This is the one point that you can see 4 different countries. So you can see Zambia, Zimbabwe, Namibia, and Botswana. This particular investment was sort of co-invested with Zambia, Africa Development Bank, Botswana, as well as JICA, so Japan International Cooperation Association. So that's an example of a successful project. There's another one that's happening at Batoka, which is arguably the largest sort of energy infrastructure project, estimated about in excess of 4 billion. Zambia and Zimbabwe have come together. They've each put aside close to about $200 million each, with the hope to then attract investment from private or international finance centers to support them. But post this, the idea is that it would then produce, close to in excess of 2,000 megawatts of electricity at this particular place, which would then be shared between Zambia and Zimbabwe. So these are some of the projects that, are successfully happening. And we believe, given, the whole agenda for energy, filling up the energy deficit, we believe there'll be a lot more projects such as this coming through in 2026.
Thank you so much, Mulenga. Rufaro, you can probably take one question with a quick answer.
One question.
Then we wrap it up, yeah.
I'll take I don't say an easy one, but one which I think I can rank. At Rufaro, which are the most congested South African power pool corridors that would benefit from interconnector capacity upgrade projects? I think you heard Lydia talking about stacking and quick results. I think if I'd had to rank 3, the engineers might disagree, but I would think the top one probably Bait Bridge in Messina. That's Zim SA. From what I've heard, the connector there is effectively non-commercial. It's from pre-apartheid days. That would be immediate. I mean, just the traffic between those corridors is immense. The second one, less for historical reasons and future reasons, would be DRC Zambia, the Copperbelt interfaces. I think we all know that the DRC is probably the future of power. And I think there's a high economic value in terms of Zambia's mining potential and DRC and that interconnector to unserved energy and unnecessary curtailment. And the second one would probably be because of our third one, would probably be because of the focus on hydro, would be Zambia and Zimbabwe, Kariba. I think that's been long overdue. And as something that was such a force of change when it was built, I think it's due an upgrade.
Thank you, Mulenga and Rufaro. That's it from our side. Over to you, Vimbai.
Thank you so much, Lydia. Mulenga, Rufaro, that was absolutely amazing. I think we could go on for another hour, but it was really great to hear the insights around the region, and also just great to hear the positivity around it, especially with all the negativity flying around globally in other aspects. It's really great to hear where we can have the small wins. I really liked what you talked about just going for the small wins, and that's really how you reach the scalability, and not going too quickly for wanting a whole nuclear power plant. I think that was a very, very, very good outlook on that. So thank you very much. I really wish we had a little bit of more time to discuss, especially the Lobito corridor. It's a very big thing even for us internally now as we come up to our mining series on the sidelines of mining in Durban and Cape Town next month. So that's really something that a lot of our members are interested in. So I'm sure we'll organize something during the year, but I'm also hoping that you'll all be with us in Cape Town and we can pick up that chat. In addition, I think for the next week, this week we still have the North Africa Outlook, which is at the same time on Thursday, with a different panel also from that region. And next week we'll look at East and West Africa. So I do hope that everyone will join us. But yeah, thank you so much again to our speakers. That was really, really special. So thank you. Appreciate you opening the year with us.